Massive stock sell-off as concerns grow that the trade truce between the U.S. and China may not actually be much of a truce. The Dow closing down almost 800 points, wiping out yesterday's gains and putting the market at risk of losing all of the gains it's made this year. CNN's Allison Kozik is live at the New York Stock Exchange.
Here we go again. Odds are that's how buy and hold investors were feeling on December 4th when the stock market took yet another major single-day hit. Question becomes, will uncertainty, fear, and chaos continue to rule the financial markets for the remainder of the year? Or will Santa Claus deliver a Christmas miracle? It's time once again to tune out the hype and focus on the facts. Yes, facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. You know, on our show, we often try to take a break from talking about just financial markets to focus on broader topics related to saving for retirement. But you know, it's been quite difficult the last few months with so many dramatic changes and developments rocking the markets on almost a daily basis. If you're retired or you're within 10 years of retirement, you need to be aware of these changes and to understand how they could impact your financial future. So with that in mind, we are going to take a comprehensive look at the markets again on today's show, tying together all the major issues that we've been discussing recently. Volatility, bonds, interest rates, the trade war, and much, much more. The goal is to give you the right perspective for making sound financial decisions in 2019 and beyond. And helping us today will be our guest, John Najarian, as well as financial advisor David Wright. But first, let's take a closer look at the latest wild swings on Wall Street and where the stock market could be headed by the end of the year.
Get off! Get off! She's going! Get out of there, Tom!
You know, we've had a little bit of fun these past few months coming up with visual metaphors for the wildly volatile stock market. At times, the point swings have been so swift and so extreme that it does, in some ways, almost seem comical. The December 4th swing is a great example. On December 3rd, stocks rallied big time based upon reports that the United States and China had made progress toward resolving their ongoing trade war at the recent G20 summit. The S&P 500 and the Dow Jones Industrial Average both gained 1.1%, while the NASDAQ rose by 1.5%. How long did the optimism last? Well, sadly, less than 24 hours. By the end of the day on December 4th, all the previous day's gains had been erased and then some. The Standard & Poor's 500 index fell nearly 2%, the Dow dropped 1.85%, and the NASDAQ 1.78%. Now, most analysts agreed that one of the key reasons for the quick sell-off was the arrest of Meng Wanzhou, CFO of a major Chinese technology company. The news quickly threw cold water on any hopes of the speedy resolution to the trade war, which has been one of the key drivers behind the record levels of market volatility that we've seen all year. The Trump administration has levied tariffs on a total of $250 billion of imported goods from China so far. Now, that represents half of all Chinese imports, and the president has boasted that he's willing to go to 500, meaning to impose tariffs on all Chinese imports. Now, China, of course, retaliated with tariffs of $110 billion on U.S. exports and imports into their country. And already the escalating battle has resulted in closed plants, lost jobs in both countries, and more negative impacts are expected if we simply cannot reach any equitable agreement. All year long, the trade war, probably more than any other issue, seem to have undercut investor optimism and keep the markets reeling. This is in spite of the fact that a lot of domestic economic data has been extremely positive for the first time in years, including GDP growth exceeding 4% in the second quarter. 4% GDP growth was one of the president's chief campaign promises, and in fact, one of the key reasons for slashing the corporate tax rate. Despite the achievement, however, along with relatively strong GDP growth in the third quarter, Wall Street has remained skittish. Since early October, it's become clear that big investors are increasingly skeptical that the president's strategies can maintain that level of growth for the long term, especially with the trade war and so many other issues undermining his effort. I'll talk more about the trade war and many of the other major concerns that are weighing in on Wall Street as the year draws to an end, some of which are actually quite new. But first, I want to again point out one especially troubling new development that also played a role in that huge sell-off on December 4th, which I mentioned on last week's show. On December 3rd, the difference between the yields on the 2-year and 5-year U.S. Treasuries became inverted, marking the first indicator of a flattening yield curve. At the same time, the difference between the 2-year bond and the 10-year bond fell to about 13/100ths of 1%, which is about as close to flat as you can get without actually being flat. But as I also mentioned last week, the dangers of a flat yield curve are something I've been cautioning investors about for 3 years now. In fact, I first warned about it in an appearance on CNBC's Closing Bell in December 2015. Yeah, 3 years ago already, just after the Federal Reserve approved its first interest rate hike after 7 years of holding rates near zero in conjunction with quantitative easing. While the yield curve isn't fully flattened yet, the milestone hit on December 3rd was indeed a significant potential warning sign for the economy, and possibly another major driver behind the huge drop one day later. So what does this warning sign mean for the financial markets for the remainder of 2018? And what does it mean for the Federal Reserve heading into its final official meeting of 2018 this coming week? Most importantly, what does it mean for you, for everyday investors? And we'll talk more about that in just a bit. But now it's time to welcome our first guest, John Najarian. John began his career as an options trader in 1981, following a stint as a pro football player. He now runs his own investing education website, Investitute.com, and is the author of the book, How I Trade Options. He's also regular on CNBC's Fast Money and is always in demand as a speaker and market analyst. John, I know it's only been a few weeks, but welcome once again back to the show. We're really happy to have you.
Great to be back with you, David. Thank you very much.
So I have to ask, where are you? What is all that we see in the background?
Yeah, that's O'Hare Airport. Little flight delay. It's that time of year. It's not just Christmas and heading into the holidays, but it's also the time when we get flight delays. So your guys are very accommodating, and we made it work.
Well, that's great. Well, you're very accommodating. We appreciate you being in the airport there, and hopefully we don't get any smart aleck making rabbit ears behind you there while you're on television. But when we spoke just a few weeks ago, you were pretty optimistic about 2019. And you said, gosh, if we see President Xi and we see President Trump shaking hands at the G20 summit, that would be a good thing, something to be optimistic about. And that pretty much happened. Some pretty good news coming out of there. But yet the volatility hasn't gotten any better. In many ways, it's gotten worse since then. What do you make of that?
Yeah. Well, I think, David, it's because at first, right after that handshake that you described, the Chinese didn't admit anything. And I don't mean admitting they steal technology or anything like that. I mean, they didn't even acknowledge anything happened in the meeting at all for basically 5 days. And that really caused people to start speculating as to whether President Trump might have stretched the truth a little bit. Then they finally started admitting, yes, we're going to start buying soybeans. Yes, we're going to start doing natural gas, liquefied natural gas purchases again. And that was the first time we really had a positive from what we thought was a very positive meeting that would lead towards a 90-day cooling off period and all that. So once we got that behind us, the volatility for that particular segment of the market came down. But then, of course, as you say, we got a whole bunch of other stuff, David, thrown at us from Theresa May over in the UK. We also had Jay Powell, our Fed chairman, back and forth with some comments that people worried about exactly where the economy was and thus the volatility you just addressed.
Mm-hmm. So you're pretty optimistic about 2019, but for this block, just sticking with the whole tariff and the whole trade war issue, in the last minute or so we have in this segment, tell us, obviously if within 90 days there's a deal that's struck that's at least in the middle or goes toward our side of the game board a little bit, that's good for the markets. But what if we don't get a deal within the 90 days? Then what do you see happening as 2019 unfolds in the markets?
Well, yeah, if we don't get that, David, then I think big industrial companies that get 60% of their revenue overseas, not all of it from China, of course, but I think it hurts all of the trading partners. So if we don't, after 90 days, reach some sort of an agreement and a ratcheting back, for instance, of tariffs in particular, like right now, China's talking about cutting the tariff from 40% to 15% for imported autos from the U.S., that's a positive step. If we don't get anything more than that, then I think we're right back to, who blinks first? Does the president blink or does China blink? And those games of chicken can be pretty dangerous.
Yeah, it's interesting. A lot of people say, we can win the trade war because our markets seem to be saying so versus how the Chinese markets have reacted. But it's hard to win a trade war. So stay with us, John. Again, we appreciate you taking some time there at Chicago O'Hare. And you stay with us, too. We'll be right back with more words of wisdom from our good friend, John Najarian, on the Income Generation.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 core values to help protect your money in good times and bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Metal right now between stainless steel and aluminized metal has increased significantly. The 25% tariff that come into play really has upped our cost of manufacturing about 39%.
And that's one industry executive explaining how the president's trade war with China is negatively impacting his company's bottom line. But other industry leaders have spoken out against the tariffs, which is why hopes were so incredibly high for some sign of a resolution when Trump and Chinese President Xi met at the G20 summit in Argentina just last month. Those hopes, as we mentioned, have largely been dashed, and that's somewhat troubling indeed in light of all the other issues weighing on Wall Street as 2018 draws to a close. In fact, there are so many major concerns on the global economic front right now that the return of steady upward momentum to the markets by year end really would be sort of close to a Christmas miracle. We've discussed a lot of these concerns in recent weeks, and we've been talking about some since the beginning of the year, but others, like the inverted yield curve we just mentioned, are much more recent. New data from the Commerce Department shows the U.S. trade deficit jumped to a 10-year high in October. This despite the fact that one of the goals of the Trump administration's efforts on trade was to reduce that trade deficit. According to the report, the trade deficit increased 1.7% to over $55 billion, the highest level since October 2008. The increase means the trade gap has now widened for 5 straight months. That same report showed that private employers hired fewer workers than expected in November, suggesting a moderation in the pace of job growth, which had been extremely strong up till now, according to most figures. These were just the latest indicators pointing toward the possibility of an economic slowdown and possibly even a new recession on the horizon. Now, obviously, that's deeply concerning for Wall Street because, as we've discussed on previous shows, the value of the president's economic policies has already been priced into the market based on optimism. The stock market rose by some 25% between the president's election in late 2016 and January of 2018, before all the volatility started. At this point, the U.S. economy pretty much needs sustained economic growth of 4% or so over the next several years in order for corporate earnings to catch up to what seem to be today's already overinflated stock prices. But again, that scenario is looking increasingly unlikely as more and more data and projections point to the economy at least stalling, if not the possibility of it completely breaking down at some point in the not-too-distant future. The housing market, for example, has indeed been slowing dramatically for several straight months and is expected to continue shrinking well into the new year. Meanwhile, fluctuating oil prices are a major concern for the markets once again. And there has been a talk of a possible brewing crisis linked, yes, to subprime auto loans. So you can add a host of global concerns to this, as well as, for example, the potential fallout from UK Prime Minister Theresa May's Brexit plan, general economic turbulence across Europe and Asia, and add all these things to a list of issues. And I haven't even mentioned the federal budget deficit, which jumped another 17% in 2018. Here's the bottom line. The fear remains the driving emotional force for the financial markets toward the last quarter of this year. Could something happen to eliminate that fear, or at least reduce it enough to stabilize the markets heading into 2019? We'll know the answer to that question after the Fed holds its final meeting of the year in just a few days, and we'll discuss that also in just a bit. But right now, it's time to welcome back our good friend, John Najarian. You mentioned when we were together just a few weeks ago that I mentioned the possibility of a flat yield curve, and you said, well, a flat yield curve, of course, is never a good thing for the economy, but it's not flat yet. And of course, that seems to have changed a little bit. It got a lot flatter just over the last few weeks. But then, almost at the same time, Powell, in response to that, said, well, all of a sudden there's a more dovish tone where, maybe they won't try to hike rates 3 times next year. What do you make of all this? And when you put all this in the big blender and push the button, what comes out?
Well, just like you're saying, David, the issues here are, that we just talked about trade. Now we're talking about the Fed and whether or not the yield curve is inverted by the Fed or by traders that anticipate the rates are going up, because it could invert either way. The information that we have right now from the Fed is that they're not going to be as aggressive as people feared. Goldman Sachs had, of course, four, count them, rate hikes on the table for 2019. Now they've cut that back to 1. So I think we're not going to be dialing in as much on the short-term boost to interest rates. That's good in terms of not inverting the yield curve. And, this was just one other thing, that the volatility you spoke of at the top of the show, where we're saying we've had the 200-day moving average, which of course is a smoothed average for technicians look at for where the market is. We rolled over on that. All of a sudden, we were very close to an inverted yield curve. And then we had the issue with China, and China not admitting that we had a deal, at least for a cooling off period. All of that hit the market at once. So pulling out each one of those pieces like you just did with the Fed, yes, it is important that we don't continue to see rate hikes in the short term. And if we don't, I think longer term, like 12 to 18 months, we're going to do very well in the market. I worried that the Fed might overstep. Now I've pulled back and I'm more sanguine about it and optimistic.
So in other words, if the Fed stays out of the way of the markets, that's a good thing. I want to get your take on this, because you mentioned that the Fed could create the flat yield curve by increasing short-term rates, or that traders can create it. A few weeks ago, we had Mohamed Al-Arian on the show, who says, well, if a flat yield curve is created artificially through something like that, then he's not worried about it. When he worries about a flat yield curve is when the long end of it comes down, because we're just not getting the growth that we need to be getting. And I've been looking at it as a flat yield curve and is bad no matter what. In the last minute or so we have in the segment, what's your take on that? Do you have an opinion on that?
Yeah, I think it's bad no matter who does it. Traders, of course, they wouldn't do it to hurt the market. Traders would do it because they anticipate that they're looking forward 3 months, 6 months, a year into the future, and that's what traders do. Real traders now, computers and algorithms, they trade second by second, minute by minute. Different story. So Mohamed Al-Arian, who I respect a lot, is absolutely right. It doesn't matter which one of those two forces is at work to lift interest rates if they're both not in the camp of lifting interest rates, because either they're anticipating it in the case of traders, or in the case of the Fed anticipating inflation, or employment data that tells them that they have to increase interest rates to slow things down to a simmer. If neither of those two are happening, then I think we're just fine. And Mohamed Al-Arian, very smart guy over there at PIMCO, I think he's spot on.
Yeah, I'm certainly not going to argue with Mr. Al-Arian when it comes to economic issues, and as a trader,
Sure.
you'd probably agree with that sentiment. We need to leave it here for this segment, John. We'll be right back, though. And you stay with us, too. We'll be back with more from John Najarian on the Income Generation. I'm David Scranton.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model.
Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
Read David J. Scranton's groundbreaking new book, Return on Principle: 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
Last week, we devoted much of the show to discussing the Federal Reserve and the tightrope that it's been walking in its effort to normalize monetary policy without triggering a recession or the next major stock market drop. In a way, it's all on the Fed to maintain stability and to avoid disaster. After all, it's what I believe reckless overuse of artificial stimulus in response to the financial crisis is largely responsible for a lot of the uncertainty that we're dealing with today. Now, if you're a regular viewer, you know that I've frequently talked about how the Fed's unchecked use of the stimulus called quantitative easing after the market collapse of 2008 and 2009, and how it was really one big economic laboratory experiment, made even bigger after other struggling countries followed our lead and launched their own massive easing efforts. All that artificiality has disrupted the normal flow of the economy, as well as the financial markets in many ways, creating a new age of unprecedented economic uncertainty. One thing that is certain, however, is that the Fed's job heading into its final meeting of the year, set now for December 19th, is actually quite a tricky one. and Wall Street will be closely weighing its every word. Chairman Jerome Powell is well aware of this, and he's been careful in recent speeches and interviews to strike an optimistic tone about the economy without sounding overly committed to sticking to his schedule for raising short-term interest rates as many times as 3 next year in 2019. Despite the recent market turmoil and all the other challenges we've discussed today, as of now, the Fed is expected to move forward with one more modest rate hike in the December meeting. Powell and the rest of the Fed have also signaled, as I said before, that the broad direction of short-term interest rates will be higher in 2019, but they haven't quite committed to those 3 additional increases next year, and have softened it, indicating that it could possibly be less. Under the pattern it's tried to follow since it started raising rates again in 2015, the Fed would likely institute another rate hike in March. But if it fully adopts a new data-dependent strategy, as many experts anticipate, it might delay increases at some upcoming meetings. Now, that's certainly the strategy that the president would prefer. In fact, he's harshly criticized the Fed's pace on raising interest rates all year long, blaming Powell for much of the market's volatility. And yes, that definitely has been a factor. In fact, when Powell struck a new, more dovish tone in a recent speech, calling rates near neutral for the first time, the market read it as a sign he was ready to take his foot off the gas pedal, and the Dow actually responded with a 618-point jump in one day. Now, of course, in keeping with the pattern of wild swings that's been typical for the markets all fall, the optimism didn't last long, and the Dow dropped again within just a couple of days. And as I explained last week, the Fed's job is such a tricky one because if they announce that they plan to back off raising short-term rates or significantly slow the pace, investors could read that as a sign that they're losing confidence in the economy and possibly admitting that a new recession is on the way. On the other hand, if they fully commit to their schedule and that pace really is too aggressive for the economy to handle, it could actually flatten the yield curve and or trigger the next recession and an accompanying sustained stock market drop. Along with nervous investors, there are other matters complicating the Fed's tightrope, all byproducts of their great economic laboratory experiment. For one thing, the Fed's inflation benchmark for further rate hikes is 2%. And recently, inflation has stalled. In fact, a new study suggests that it may soon fall back below 2%, that milestone that it achieved only for the first time just a few months ago. More importantly, the yield on the 10-year government bond recently fell back below 3%. I've been saying all year that long-term interest rates, like the one on the 10-year bond, are going to continue to experience a strong resistance level or glass ceiling at just near that 3.25% point for several reasons. And so far, this seems to be holding true. If it continues to hold and the Fed moves forward with its goal of having short-term rates up to 3.5% by 2020, well, then clearly the result will be a fully inverted yield curve, a major obstacle to economic growth, and one of the reasons why I think the Fed really will slow down on these rate hikes going into 2019. As I also pointed out last week, an inverted yield curve preceded both of the last 2 major market drops, the one from 2000 to 2002 and the one from 2007 to 2009. And while the inverted yield curve is a major potential danger involved with raising short-term rates, there actually is another danger involved with not raising them further. The Fed knows that it needs short-term rates as high as possible in order to have some gas in the tank, so to speak, for lowering them again should we hit another recession, which, as we've discussed, some data suggests is very possible. So, as the Fed prepares for this next tricky stretch of the tightrope walk in its December meeting, what can you do to prepare for so many unknowns heading into 2019? Well, we'll be covering that more in just a bit. But right now it's time to welcome back for one final segment our good friend John Najarian, reporting in from Chicago O'Hare Airport. John, you mentioned just before the break there that the trading, the algorithms, and I know you've written about that recently. You know, I'm thinking that the reason the markets, I'm looking at the markets having turned, I said, gosh, first half of the year, the market shrugged off all the bad news, focused on the good news. Now they're shrugging off all the good news, focusing on the bad news. You think it's the algos. Talk about that.
I think they're certainly contributing to it, Dave. I think the issue is that we always know that markets take the stairs up and the elevator down. We go down much faster than we go up. And that's just a fact in non-computerized markets, like in the 1920s all the way through the 1990s. But now that we've reached these near speed of light trading through algorithms, it's even more so. And I think that the market did, as you say, dismiss a lot of the bad news in the first part of the year, but it wasn't as much and all at the same time. We'd have to deal with one of those issues, and then we'd have a quarter, and then we'd deal with another issue. We didn't deal with, like I say, the 200-day rolling over for the S&P, the Fed maybe getting a little overzealous, and China basically not admitting that we actually had any kind of constructive talks. We got all that at one time, and that's why the algorithms just went wild to the downside. I think a lot of those asset managers that follow those kinds of trading will have done very well, even though it hurt you and me and most of your listeners.
It's the perfect storm in many ways, which you described. So, we always talk in the show about people part of the income generation, retired or within 10 years of retirement, needing to protect their money. In the final minute or so, though, please tell us, is this a good time? If somebody wants to protect their money, they can't really protect it with call options, but right now with the volatility, it seems like, gosh, I could increase my income writing call options, the premiums must be up, and I may not protect my downside, but at least I'll increase my income. 45 seconds. What do you think if people want to stay in the market but be conservative?
Well, just like you're saying, in the name of your show, income generation. I would definitely do that. You're right, volatilities are higher, which means you're getting a better premium. You're collecting like Warren Buffett likes to do. When he sells premiums, he's collecting on those premiums. He's not paying them out. And lastly, I'd say a lot of folks might want to pull a little stock off the table and instead put on some call spreads or simulate the position, the long position, through an option program of one type or another. Not enough time to cover all of it now.
Of course not.
But that'd be a great way to have major assets on the side and still be in the market.
Take some off the table, increase your income with covered calls, and simulate some equity holdings with options exposure. John, thank you very much. Have a great flight. It's great having you. And you stay with us here on The Income Generation. We'll be right back.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Available now.
As hard as it is to believe, yes, it's that time of year again. And for most people, New Year's is a time for looking back and also looking ahead. It's a time for celebrating achievements, appreciating what we have, and making new goals and resolutions. And in light of all we've discussed on today's show, I'd like to suggest a few financial resolutions for you to consider heading into 2019. If you haven't yet retired, take some time and do a top-down budget analysis to help determine roughly how much income you'll need for retirement. As I've explained before, a top-down budget analysis involves reviewing your current expenses and determining which of them will go away after retirement. For example, do you expect to have your house paid off after you retire? Are there significant work expenses you'll no longer have? So after doing a top-down analysis, many people realize that they'll be able to maintain their current lifestyle after retirement with less income than they thought they'd actually need, and that's great. But it's only one step in the process. Next, you must sit down and identify your retirement goals. More time on your hands means you'll be doing more things, and things might cost money. I realize that I may sound like a broken record with some of the points I stress, including this one, but you know, identifying your goals is vital to having a successful financial strategy. Do your goals involve a major purchase, like a boat or a second home? Do they involve leaving a large legacy to your family? Or do they involve having secure savings and reliable income to maintain your current lifestyle, to pursue your hobbies and interests, to meet your medical needs, and to keep pace with inflation? Well, for most people, their goals fall into the last category. They are indeed income-based goals. So once you've identified them and you've determined that they are income-based goals, you can now add the estimated cost of meeting these to the bottom line of your top-down budget, giving you a much clearer picture of your real retirement income needs. And third, most importantly, if you're retired or within 10 years of retirement, make it a resolution this year to shift your strategic focus from growth to retirement income if you haven't already done so. If your goals are income-based, as most people's are, then making that shift is the first most important step toward greatly improving your odds of achieving these goals, especially in the midst of so much market turmoil and in an age of this unprecedented economic uncertainty. The best way to start is to find and meet with an advisor who specializes in income-based strategies, who can show you how to create a reliable income stream and reduce your portfolio risk, and how these two can go hand in hand. If you are within 10 years of retirement, you're at the right stage in life to make this important paradigm shift. And in light of everything happening with the markets as the year ends, I believe the timing could be absolutely perfect in that respect as well. Now it's time to welcome our next guest, David Wright of Wright Financial Group in Toledo, Ohio. He has 30 years of experience in the financial services business. He and his team work closely with clients to design custom-built financial strategies and specialize in retirement planning. Dave, welcome back to the show.
Thanks for having me back, Dave.
You know, not only are you a good friend of the income generation, but you're also a good friend of mine, so it's always a pleasure to have you here. So what do you think has changed in the sentiment? You know, at the beginning of the year, it seemed, you know, you just heard John Nigerian talk about some of the more technical things, but at the beginning of the year, it seems like everyone you know, would shrug off any kind of bad news and focus on the good news, and the market kept going up. Now all of a sudden, it's like somebody flipped the switch and they're focusing on the bad news and ignoring the good news. What's going on out there? What are you hearing from people that you talk to every single day in your conference room?
Well, every day in the conference room, I'm seeing more and more skepticism. We do a lot of public workshops and folks that we talk to on a daily basis. There was this thing that happened in the 2008 frame when markets were dropping and folks weren't opening their statements. We're starting to see that happen all over again. People are starting to see red ink in their quarterly statements. And we deal with people here in Toledo that are, you know, approaching 5 to 10 years before retirement. And that gets a little disconcerting to them.
And think about it. Markets are only down 10%, maybe a tiny, tiny bit less. You know, what happens when they're down 20 or 30%? Are you able to at least share some stories from 2008 with them to maybe motivate them to do something so they don't have to deal with the 30 or 40% loss like they did a decade ago?
It's really funny, Dave, because a lot of times I'll talk to someone that comes in from the radio show or from a workshop that I do, and I'll even ask the question, and it'd be like an epiphany to them. They'll all of a sudden say, you know what, you're right. I had a 6-digit loss back in 2008. That wasn't a very good time. And then I remind them that they were 10 years out before retirement and that now they're on top of retirement. A drop like that could devastate all of their goals. And when you do a top-down analysis, look at what their needs are, and you realize that most people that we talk to have a gap between their retirement plans and their Social Security.
And David, we need to leave it there in this segment for just a minute. We'll talk about that gap when we come back. Stay with us. We'll be back with more on the income generation. Welcome back to the Income Generation. I'm David Scranton. I'm here with David Wright from Toledo, Ohio. Now, David, of course, you know, our producer was forcing me. He's in my ear saying we need to go for a commercial break. I guess that's the advantage of me being from the East Coast. I'm not afraid to cut you off the kneecaps. You Midwesterners are too nice. You'd never do that. But you were talking about a gap after doing a top-down analysis. Continue with that thought, the gap that you're referring to.
Well, a lot of people, when we look at their statements, we realize that the income that they're generating from their current investments is nil. They're invested totally for growth. And watched your show before, I know that the equation for investing is TR, total return, equals growth plus income. And a lot of people don't realize that income is an important component of retirement investing. So if we do the analysis and realize that they got to cross their fingers and toes, hoping that the market continues to rise just so they can meet their future gap in their retirement plans, that's scary to them. And they don't know that there's a better way to invest for retirement. And
those are great words of wisdom. Whether the market's volatile and maybe trending more downward, as it's been for the last couple of months instead of upward, or whether it's trending upward like it was earlier in the year, but in terms of the sentiment, now it seems like more people would be happy to invest for the I, the income, instead of the G, the growth. Maybe not even if they don't even need the extra income. Let's say they have a big pension, big Social Security, they might be more willing to invest for the income just because it's a more conservative way and it might protect them from potential market losses should this thing really get ugly. Your thoughts about that?
Well, that's true. That's true. I mean, again, it's a function of what do you need your money for. Sometimes I find folks that have plenty of money. They've got a private pension, far and few between, but some do. Some have their Social Security, but have their debts paid. But most people, when you ask them the question, everybody wants to have maximum return for minimum risk, but maximum return for what? So most of the time people gravitate towards, I'd like to have some income down the road to fill in the time traveling to my grandchildren. And they understand that working all of these years to grow a big balance and suddenly now needing that balance to be a functional income stream, it's a totally different skill set that I'm finding that people just aren't learning out there. And that's what our goal here is to help them with.
So to wrap it up, 30 seconds or less, what are the best words of wisdom you can give to our income generation viewers?
When it comes to investing, this is the key. Invest for the I and not for the G.
I love that. I love that. Where did you actually make that up? I love it.
No, I actually didn't. Some other man of wisdom I heard it from, but it's really true. People
well, guess
need
what?
To invest.
Since it's not yours, now I'm going to steal it, because it's not really stealing if I don't know who I'm stealing it from. David, thank you so much. It's always a pleasure. We'll be right back with more on the Income Generation. I'm David Scranton. I'd like to thank both of our guests for joining us for another episode of the Income Generation. Of course, I'd also like to thank you, our new and returning viewers. Here's a question for you. Have you ever driven 100 miles an hour in your car? Now be honest. And if you have, here's another question. Why don't you drive 100 miles per hour all the time, everywhere? Obviously, that's a silly question. Why? Because the answer is obvious. You don't do it all the time because you know that you'd be pushing your luck. You know that the risk of getting a huge speeding ticket, or even worse, having an accident, greatly outweighs any possible benefits of driving 100 miles an hour every time you get on the highway. I use that analogy sometimes to illustrate the importance of risk reduction for investors over the age of 50, particularly in this new age of unprecedented market uncertainty. The point is that for all the complex details we've discussed today about volatility, an inverted yield curve, the trade war, and the Fed, please, please, please don't ever overlook the importance of plain old common sense. Common sense is what tells you it would be foolish to drive 100 miles an hour all the time, everywhere, considering how much the risk outweighs the reward. Now consider that in relation to an artificially overinflated, highly volatile stock market that could possibly climb another 10%, but could just as easily succumb to the next major sustained drop, a drop that history suggests has to be at least 40% and could be as much as 70%. What does common sense tell you about the risk-reward equation in that scenario and about pushing your luck? Well, taking it further, What does common sense tell you about continuing to invest for growth in a high-risk market when your financial goals are most likely income-based? And you understand that in order to increase your retirement income, you actually have to reduce your market risk? Well, again, common sense combined with all the timely details that we've been discussing on today's show may be telling you that it's time to make some changes, or at the very least, it's time to make learning more about investing for income perhaps one of your top New Year's resolutions for 2019. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it is absolutely critical that you stay informed and up to date. And as you know, right here is where you can do it on The Income Generation. I'm David Scranton. Thanks again, and we'll see you next week. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.